Anthony, in your experience, do investors really understand the risks they're taking with their investments?
No, I don't think they do, Martin. But I wouldn't be too alarmed about that. First of all, I would try and define what we mean by risk. The word itself is quite concerning for investors. But if you try and understand what your aims and objectives are, then you can try and understand the consequences or the likelihood of not achieving those aims and objectives. And that is what I think, as an investor, you should be thinking about in terms of risk. So less about the untoward fear of investing in something which might go horribly wrong, and much more about predictability. It really is an important point to understand what you mean by risk, because risk is almost the very parameters by which you will invest successfully or unsuccessfully if you go outside those risk parameters that you've set yourself.
By risk, when it comes to investments, you look at capital risk, the risk that the value of your investment goes down. You look at income risk, that your income from your investments isn't as high as you would want. There are other risks as well. It might be foreign currency risk if you take the decision to place money in foreign currency denominated investments. When it comes to the investor community, though, which are the risks which people commonly misunderstand or perhaps don't think about at all?
Well, they're all risks that one should consider. But let me say to you, if you're an investor in fixed interest and equity markets, they're risks that the people you provide capital to will be thinking about very hard indeed. There'll be hedging currency. There'll be many large companies have enormous risk departments just dealing with all these issues. You know, for me, I think as the private investor, you should be more concerned about you yourself misunderstanding risk and making investments that are less about discernible, predictable, reliable returns and more about speculating. So you may be invested in the equity market, for instance, with the intention of making a more significant return that is really reliable, that is really realistic. And that, I think, is where we go wrong in misunderstanding risk.
Whose responsibility is it to get the personal investor up the learning curve when it comes to understanding risk? Is it down to the personal investor? Should it be the financial firms and the advisors who they can approach about investments, or is it the duty of the regulator to protect the investor from an adverse risk appetite?
Well, that's a really good question, because I feel at the moment that the onus is put by the government, by the regulator, on the advisor, if one's using an advisor, to quantify the risk. And it has become a box-ticking exercise, which is really very inadequate. So your advisor will ask you, are you a low-risk investor or a medium-risk investor or a higher risk? And he will tick the box. But you know what he's doing, Martin? He's considering his business risk and less of your investment risk. So you have to decide, you have to do your utmost, I would argue, to try and understand what the risks you are undertaking.
So it does come back to the personal investor.
So ultimately, I would argue that if we, you, me, everyone, the government, can educate ourselves in trying to understand what it is we want from our investments, less about speculation, less about gambling in the stock market, more about discernible returns, more about good corporate governance, reducing risk in things going wrong at board level, for instance, and therefore at earnings. So I think we all have a role to play here. At the moment, the emphasis really is left with the advisor to quantify the risk, having asked some really terribly basic questions to an individual what their risk appetite is. And they may not even know, they may not, as you allude to, understand what their risk requirements are.
So if I'm a personal investor and I say, yes, I want medium risk, it's really down to me to make an effort to understand what medium risk really means and what I'm exposing myself to.
It is, and more so to make sure that your advisor, if you're using an advisor, understands what you mean by medium risk, because he may then be able to help you out in identifying whether you are genuinely a medium risk investor, because you might actually be a low risk investor.
Anthony, one big decision that investors have to make is, do I take financial advice before making my investments, or do I, so to speak, fly solo and make my own decisions? What's your advice on this?
Well, my advice would be that depends upon how sophisticated you are in understanding financial matters. If you're coming to the investment arena for the very first time and know little about financial matters, then I would seek advice. And sadly, the quality of advice you get depends on how much you're going to pay for it. If you are an accountant yourself, if you understand financial matters on a much more significant understanding of these financial matters, then by all means, fly solo, by all means, go it alone, do your own homework, understand the risks, look at your aims and objectives.
You talked about fees there and the investor having to pay for advice. And you know there's been a lot of debate, a lot of discussion about the fees that are paid to fund managers. What are your views? Are those fees, generally in order, or are they excessive?
Well, I think, Martin, it really does depend upon the product that you are choosing to invest in. There is no doubt in my mind that some products are heavily overpriced. They're weighted too much in terms of the fee towards the underlying fund manager. We think of performance fees within the hedge fund community, for instance. And at the other end of the spectrum, maybe index tracking, there are products which are very lowly priced and can retain the same sort of returns as an index by their very nature. So it does vary enormously, and it is important to understand what level of fee you will be paying. Now, I do think the regulator, the government and the regulator, has had a very useful role to play in this in recent years, in forcing the investment community, investment professionals, fund managers, independent financial advisors to make more explicit what their fee charges are. So you can make a much more educated guess now than was the case in the past in terms of what your fee levels are likely to be. I should say at this point that the initiatives we've seen from governments in the past to make very simple investment products very lowly priced hasn't really worked. The investment community hasn't been very keen on taking up some of those very lowly priced products because it can be quite an expensive process to provide product to the retail community in particular at a very, very low price.
So by the sound of it, you think the regulator's doing a pretty good job then in terms of regulation of fees?
He's doing a much better job, I would say, than has been the case in the past. The city understands, the investment community now generally understands what's required of them in terms of an appropriate level of fee charging.
But it's also important that the personal investor doesn't turn a blind eye to that percentage which they're paying in terms of fees. It's typically a small percentage, and people will maybe inclined just to ignore it and not think about how it impacts upon their investment return over the longer term. Is that a fair observation?
You know, my observation over the years would be that actually the retail investor does look at the level of fees he's paying.
Right.
He looks at what the return has been, and he does make a judgment about the level of fees that he's been paying. And too often, I think, the level of fees have discouraged him from investing perhaps when he should have been investing. So I do think people do look at fee charges. They are concerned. They have been concerned about fee charges. And the press has done a relatively good job of taking up some of the more extreme examples of too high fees.
A fund manager that underperforms, particularly year after year after year, Should they be repaying their fees to the
Well,
investor?
I don't know how the fund manager would repay those fees. Quite frankly, if the funds underperform significantly, investors tend to take their money out over a prolonged period of time, and his funds dwindle, and his business risk rises, and he goes out of business in theory.
Okay.
But I don't think we'll ever see underperformers reimbursing fees, because fees go to provide a lot more simply than buying and selling investments. There's a good deal of admin that takes place behind that.
Yes, I mean, a certain amount of the fees which you do pay go towards such things as research undertaken by the financial firms.
Yes, I think that's true. There is a good deal, and depending on the size of the firm, there's a good deal of resource applied to researching companies and the underlying investments that they offer the retail investor.
Thank you.
Thank you.